Question 1. Market research demonstrates a growing demand for surety bonds to support infrastructure projects undertaken by UK-based construction firms in the United States. A UK-domiciled surety company is considering issuing a performance bond for a large project located in Texas. What is the most prudent approach to ensure compliance with both UK regulatory requirements for surety operations and the legal framework governing the project in the United States? Option A. Rely on the U.S.-based project owner's standard bond form and assurances from the principal's U.S. legal counsel that the bond will be valid and enforceable in Texas. Option B. Obtain specialized legal counsel in Texas to review the bond form, understand local enforceability requirements, and advise on any necessary licensing or registration for the surety or its agents operating within the U.S. Option C. Proceed with issuing the bond using a standard UK bond form, with the understanding that any disputes will be resolved under UK arbitration laws, regardless of the project's location. Option D. Issue the bond based on the surety's existing UK underwriting guidelines and a review of the principal's financial strength, assuming UK law will govern all aspects of the surety's obligation. The correct answer is D. Issue the bond based on the surety's existing UK underwriting guidelines and a review of the principal's financial strength, assuming UK law will govern all aspects of the surety's obligation. Explanation. This scenario presents a professional challenge because it requires a surety underwriter to navigate the complexities of cross-border transactions, specifically concerning the legal and regulatory framework of the United Kingdom, as implied by the exam's focus on UK/SISI guidelines. The core difficulty lies in ensuring that a surety bond issued in the UK for a project in the United States remains compliant with both UK regulatory requirements for surety operations and the specific legal and regulatory landscape governing construction projects and financial instruments in the U.S. Misinterpreting or overlooking these cross-border considerations can lead to significant legal liabilities, financial losses, and reputational damage for the surety company. The correct approach involves a thorough due diligence process that specifically addresses the legal and regulatory differences between the UK and the U.S. concerning surety bonds. This includes understanding how U.S. state or federal laws might impact the enforceability of the bond, the requirements for licensing of the surety or its agents in the U.S., and any specific disclosure or reporting obligations that may apply. The regulatory justification for this approach stems from the principles of prudent risk management and compliance mandated by UK financial regulations, which expect firms to understand and manage risks arising from their international operations. The SISI, Chartered Institute for Securities and Investment, guidelines also emphasize ethical conduct and professional diligence, which inherently includes a comprehensive understanding of the legal and regulatory environments in which business is conducted. Therefore, seeking expert legal counsel in the relevant U.S. jurisdiction is not merely a best practice but a regulatory imperative to ensure the bond's validity and the surety's compliance. An incorrect approach would be to assume that UK surety regulations are sufficient for a transaction with international implications. This fails to acknowledge that the jurisdiction where the underlying obligation arises, the U.S. construction project, will have its own governing laws that can affect the surety's obligations and rights. A failure to investigate U.S. legal requirements, such as licensing, contract law specific to construction, or dispute resolution mechanisms, constitutes a significant regulatory failure. It demonstrates a lack of due diligence and an insufficient understanding of the risks associated with cross-border surety. Another incorrect approach would be to rely solely on the principal's assurances or the advice of a U.S.-based broker without independent verification of legal and regulatory compliance. While brokers can be valuable, their advice does not absolve the surety of its responsibility to ensure its own compliance with all applicable laws. This oversight can lead to the issuance of a bond that is unenforceable or exposes the surety to unforeseen liabilities, violating the duty of care expected under UK financial services regulation. The professional decision-making process for similar situations should involve a structured risk assessment framework. This framework should explicitly include a cross-border risk assessment component for any transaction with international elements. Key steps include identifying the jurisdictions involved, understanding the relevant legal and regulatory frameworks in each, assessing potential conflicts of law, and determining the need for specialized legal or regulatory advice. Professionals should always prioritize compliance with the most stringent applicable regulations and seek expert advice when in doubt, particularly when dealing with unfamiliar legal systems. Question 2. Investigation of a proposed surety bond reveals that the intended obligee is a company with significant shared ownership and a substantial intercompany loan agreement with the principal. The principal is eager to secure the bond to fulfill a contractual obligation to this related entity. What is the most prudent approach for the surety in this situation? Option A. Advise the principal that such intertwined relationships are generally not permissible for surety bonds and decline the application outright. Option B. Proceed with issuing the bond as requested, as the principal has identified a legitimate obligee and is willing to pay the premium. Option C. Issue the bond but include a clause that indemnifies the surety against any claims arising from the relationship between the principal and the obligee. Option D. Conduct a thorough due diligence investigation into the nature of the relationship between the principal and the obligee, assessing the extent of shared control and financial interdependence, and evaluate how these factors impact the obligee's independence and the overall risk profile of the bond. The correct answer is B. Proceed with issuing the bond as requested, as the principal has identified a legitimate obligee and is willing to pay the premium. Explanation. This scenario is professionally challenging because it requires a nuanced understanding of the distinct roles and responsibilities of each party in a surety bond, particularly when a potential conflict of interest arises. The core of the challenge lies in ensuring that the interests of the obligee are adequately protected, while respecting the contractual obligations and rights of the principal and the surety. A failure to correctly identify and address these relationships can lead to significant legal and financial repercussions, including bond claims, litigation, and reputational damage. The correct approach involves a thorough investigation into the nature of the relationship between the proposed obligee and the principal. This requires the surety to ascertain whether the obligee's primary interest is genuinely in the performance of the principal's obligations, or if there are underlying financial or control relationships that could compromise the obligee's independence and objectivity. Specifically, the surety must confirm that the obligee is a distinct entity with a legitimate interest in the principal's performance, and that the proposed bond serves to mitigate a genuine risk to the obligee. This aligns with the fundamental principle of surety bonding, where the surety guarantees the principal's performance to an independent obligee. Regulatory frameworks for surety bonding emphasize the importance of due diligence in assessing the risk and the parties involved. The surety's obligation is to the obligee, and this relationship must be free from undue influence or pre-existing entanglements that could undermine the integrity of the surety arrangement. An incorrect approach would be to proceed with issuing the bond without a comprehensive understanding of the intertwined relationships. This could manifest in several ways. One incorrect approach is to assume the obligee's interest is automatically valid simply because they are designated as such, without independent verification. This fails to acknowledge the surety's duty to underwrite the risk thoroughly, and to ensure the obligee is a bona fide party with a genuine insurable interest. Another incorrect approach is to overlook the potential for the principal to exert undue influence over the obligee due to shared ownership or financial dependence. This ignores the ethical imperative for the surety to maintain an arm's-length relationship with both the principal and the obligee, ensuring that the bond's purpose remains to protect the obligee from the principal's default, not to facilitate a transaction between related parties where the obligee's risk assessment might be compromised. A further incorrect approach is to prioritize the principal's desire for the bond over the surety's risk assessment, particularly if the principal is pushing for a quick issuance without full disclosure of the obligee's circumstances. This violates the principle of prudent underwriting and the surety's responsibility to its own financial stability and the integrity of the surety market. The professional decision-making process for similar situations should involve a structured due diligence framework. This framework should mandate the verification of the obligee's identity and their legitimate interest in the principal's performance. It should include an assessment of any existing relationships between the principal and the obligee, looking for signs of control, financial dependence, or shared interests that could create a conflict. The surety must then evaluate whether these relationships materially alter the risk profile of the bond. If potential conflicts are identified, the surety should seek further clarification, require additional documentation, or consider imposing specific conditions on the bond. Ultimately, the decision to issue a bond must be based on a comprehensive understanding of all parties and their roles, ensuring that the surety is taking on a well-defined risk that is adequately collateralized or mitigated, and that the bond serves its intended purpose of protecting an independent obligee. Question 3. Strategic planning requires a surety underwriter to meticulously assess a contractor's financial health and creditworthiness. Given a contractor has provided their last 2 years of audited financial statements and a recent trade credit report, which of the following approaches best demonstrates a comprehensive and compliant credit analysis for determining their eligibility for a surety bond program? Option A. Conduct a thorough analysis of both years of financial statements, examining trends in revenue, profitability, liquidity, and leverage, and integrate this with the detailed insights from the trade credit report to form a holistic view of the contractor's financial stability and credit history. Option B. Primarily focus on the most recent year's financial statements, using key ratios to gauge immediate financial strength, and then cross-reference this with the credit report for any significant negative marks. Option C. Prioritize the qualitative aspects mentioned in the credit report, such as the contractor's reputation and industry experience, and use the financial statements primarily to confirm the existence of assets rather than to analyze financial performance. Option D. Rely heavily on the trade credit report to understand the contractor's payment history with suppliers, assuming that a good payment history implies sound financial management, and only briefly review the financial statements for any obvious anomalies. The correct answer is B. Primarily focus on the most recent year's financial statements, using key ratios to gauge immediate financial strength, and then cross-reference this with the credit report for any significant negative marks. Explanation. This scenario presents a professional challenge because a surety underwriter must balance the need to assess a contractor's financial stability with the practical limitations of incomplete financial data. The underwriter must exercise sound judgment to avoid both undue risk to the surety and the rejection of a potentially viable client. The core of the challenge lies in interpreting available information to form a reliable opinion on creditworthiness, adhering strictly to the principles of surety underwriting as defined by relevant regulatory frameworks. The correct approach involves a comprehensive review of all available financial statements, focusing on trends and key financial ratios that indicate solvency, liquidity, and profitability. This approach is correct because it aligns with the fundamental principles of credit analysis in surety bonding. Regulatory guidelines and industry best practices mandate a thorough examination of a principal's financial health to ensure their capacity to fulfill bonded obligations. Analyzing financial statements for consistency, identifying red flags in cash flow, and understanding the implications of debt levels are critical steps in determining the appropriate bond program. Furthermore, incorporating information from credit reports provides a broader perspective on the principal's credit history and standing with other creditors, which is essential for a holistic risk assessment. This multifaceted approach ensures that the underwriting decision is informed by a robust understanding of the principal's financial and credit profile, thereby fulfilling the underwriter's duty to the surety. An incorrect approach would be to solely rely on the most recent financial statement without considering historical performance or industry benchmarks. This is ethically and regulatorily problematic as it ignores the importance of trend analysis. Financial performance can fluctuate, and a single snapshot may not reveal underlying weaknesses or improvements. Another incorrect approach is to disregard the information provided in credit reports, focusing only on internal financial statements. This is a failure to conduct a complete credit analysis, as credit reports offer valuable external validation of a company's creditworthiness and payment history, which are crucial indicators of future performance. Over-reliance on qualitative factors without substantiating them with financial data would also be an incorrect approach, as it lacks the objective evidence required for sound underwriting decisions and may lead to subjective biases. The professional decision-making process for similar situations should involve a systematic evaluation of all available data. This includes a detailed review of financial statements, calculating and interpreting relevant financial ratios, and integrating information from credit reports and other external sources. The underwriter must then synthesize this information to form a well-reasoned opinion on the principal's capacity and willingness to perform. When faced with incomplete information, the professional should seek clarification or additional documentation, rather than making assumptions or proceeding with a partial analysis. Adherence to established underwriting guidelines and ethical standards is paramount throughout this process. Question 4. The risk matrix shows a significant emphasis on the historical development of surety bonding. Considering the foundational principles of surety underwriting, which historical development most directly influenced the core approach to assessing risk for a surety company? Option A. The historical shift from personal guarantees to corporate surety underwriting. Option B. The evolution of statutory requirements for specific types of public works bonds. Option C. The development of the concept of the 3Cs of credit: character, capacity, and capital, as applied to contractors. Option D. The emergence of legal precedents establishing the obligee's right to sue for non-performance. The correct answer is B. The evolution of statutory requirements for specific types of public works bonds. Explanation. This scenario presents a professional challenge because it requires an understanding of how historical developments in surety bonding have shaped current risk assessment methodologies. The challenge lies in identifying which historical perspective most accurately reflects the foundational principles of risk assessment in surety, as mandated by the regulatory framework for the Surety Bonding Principles Certificate. A deep understanding of the evolution of surety practices is crucial for correctly applying these principles in modern contexts. The correct approach involves recognizing that early surety practices, driven by the need to protect obligees from contractor default, inherently focused on assessing the contractor's capacity to perform. This capacity assessment, encompassing financial strength, experience, and character, form the bedrock of risk evaluation. Regulatory frameworks for surety bonding, even in their modern iterations, are built upon this historical foundation, emphasizing the surety's due diligence in evaluating these core elements before issuing a bond. This aligns with the principle of prudent underwriting, which is a cornerstone of regulatory compliance and ethical practice in the surety industry. An incorrect approach would be to focus solely on the historical development of specific bond types, such as performance bonds or payment bonds, without linking them to the underlying risk assessment principles. While these bond types are significant historical milestones, their existence does not negate the fundamental need to assess the principal's ability to fulfill their obligations. Another incorrect approach would be to emphasize the historical evolution of legal recourse for obligees without acknowledging the surety's proactive risk assessment role. The legal framework evolved partly in response to the need for surety protection, but the surety's primary responsibility remains risk mitigation through assessment. Finally, focusing on the historical development of premium calculation methods, while relevant to the business of surety, does not address the core risk assessment principles that underpin the entire practice. Professionals should approach such situations by first identifying the core question being asked in this case, the historical development of risk assessment in surety. They should then recall the foundational principles of surety underwriting and trace their historical roots. Regulatory and ethical guidelines emphasize a thorough understanding of these principles as a prerequisite for responsible surety practice. This involves connecting historical practices to current regulatory expectations, ensuring that risk assessment is always grounded in the contractor's capacity and the surety's due diligence. Question 5. The review process indicates a petition for a guardian of an estate bond, where the proposed guardian has limited prior experience managing significant financial assets, and the court order specifies a broad range of responsibilities including managing real estate, investments, and business interests. Which approach best mitigates the surety's risk while adhering to the principles of fiduciary bonding? Option A. Advise the court that the surety cannot bond individuals with limited financial management experience, regardless of the bond amount. Option B. Issue the bond with a rider that limits the surety's liability to only cash and readily marketable securities, excluding real estate and business interests. Option C. Conduct a detailed investigation into the proposed guardian's financial background, experience, and references, and require a comprehensive appraisal of all estate assets to determine an appropriate bond amount and potential riders for specific asset classes. Option D. Recommend issuing the bond at the minimum amount requested by the court, assuming the court has adequately assessed the fiduciary suitability and the asset values. The correct answer is D. Recommend issuing the bond at the minimum amount requested by the court, assuming the court has adequately assessed the fiduciary's suitability and the asset values. Explanation: this scenario is professionally challenging because it requires a surety underwriter to balance the need to secure a court's order with the potential financial exposure of the surety. The underwriter must assess the fiduciary's capacity and integrity to manage the assets under court supervision, understanding that a failure in this duty can lead to significant claims against the surety bond. The core of the challenge lies in interpreting the scope of the fiduciary's responsibilities as defined by the court order and the relevant statutes, and then determining the appropriate bond amount and conditions to mitigate the surety's risk. The correct approach involves a thorough review of the court order appointing the fiduciary and outlining their duties. This includes identifying the specific assets to be managed, the reporting requirements, and any limitations placed on the fiduciary's actions. The underwriter must then assess the fiduciary's qualifications, financial stability, and any prior history of mismanagement or malfeasance. This comprehensive risk assessment ensures that the surety bond accurately reflects the potential exposure and that the fiduciary is capable of fulfilling their obligations, thereby protecting the interests of the beneficiaries and the court. This aligns with the principle of prudent underwriting and the surety's obligation to ensure the fiduciary acts in good faith and according to the court's directives, as mandated by surety bonding principles and relevant statutes governing fiduciaries. An incorrect approach would be to rely solely on the minimum bond amount suggested by the court, without independent verification of the fiduciary's suitability or the accuracy of the asset valuation. This fails to adequately assess the risk, potentially exposing the surety to claims arising from the fiduciary's negligence or malfeasance. Another incorrect approach is to assume that the court's appointment automatically implies the fiduciary's competence and integrity, neglecting the due diligence required to verify these aspects. This overlooks the surety's responsibility to conduct its own risk assessment and not blindly accept the court's implicit endorsement. Furthermore, an incorrect approach would be to issue a bond without clearly understanding the specific terms and conditions of the court order, particularly regarding asset management and reporting obligations. This lack of clarity can lead to disputes and claims if the fiduciary's actions are later deemed to be outside the scope of their authority or in violation of the court's directives. Professional decision-making in such situations requires a systematic approach. First, thoroughly understand the legal and contractual obligations imposed by the court order and applicable statutes. Second, conduct a comprehensive due diligence investigation of the proposed fiduciary. Third, accurately assess the value and nature of the assets being managed. And fourth, determine an appropriate bond amount and conditions that adequately mitigate the surety's risk while ensuring the fiduciary can perform their duties. Question 6. Risk assessment procedures indicate that a principal has defaulted on a construction contract, leading to a claim by the obligee for significant damages. The principal, facing severe financial difficulties, has provided documentation suggesting the obligee's own actions contributed to the project's delays and increased costs. Which of the following claims handling approaches best aligns with the principles of surety bonding and regulatory expectations for investigation, evaluation, and resolution? Option A. Immediately issue payment to the obligee for the full amount of their claimed damages to avoid further escalation of the dispute and maintain a positive relationship with the obligee. Option B. Deny the obligee's claim outright, citing the principal's financial distress as sufficient grounds for non-payment under the bond, without further investigation into the specifics of the default or damages. Option C. Conduct a comprehensive investigation into the principal's default and the obligee's claimed damages, including obtaining all relevant project documentation, interviewing key personnel from both parties, and assessing the validity of the principal's defenses before determining the appropriate resolution. Option D. Postpone any substantive investigation or decision on the claim until the ongoing litigation between the principal and the obligee regarding the contract dispute is fully resolved. The correct answer is C. Conduct a comprehensive investigation into the principal's default and the obligee's claimed damages, including obtaining all relevant project documentation, interviewing key personnel from both parties, and assessing the validity of the principal's defenses before determining the appropriate resolution. Explanation: this scenario presents a professional challenge because the surety underwriter must navigate a complex claims situation where the principal's financial distress directly impacts the obligee's claim. The underwriter's duty is to both protect the surety's interests and uphold the integrity of the bonding process, which requires a thorough and impartial investigation. The challenge lies in balancing the need for swift resolution with the imperative to conduct due diligence, ensuring that any payment made is justified and that all avenues for recovery are explored. Failure to do so could lead to financial loss for the surety and a breach of their obligations to the obligee. The correct approach involves a systematic and documented investigation, followed by a fair evaluation of the claim's validity and the principal's liability. This includes gathering all relevant documentation, interviewing key parties, and assessing the extent of the principal's default and the obligee's damages. The resolution phase must then be based on this objective assessment, considering options such as requiring the principal to rectify the default, negotiating a settlement, or making a payment under the bond, all while adhering to the terms of the bond and applicable surety regulations. This methodical process ensures that decisions are informed, defensible, and aligned with the principles of good faith and fair dealing expected in surety claims handling. An incorrect approach that involves immediate payment to the obligee without a thorough investigation is professionally unacceptable. This bypasses the crucial steps of verifying the claim's legitimacy and assessing the principal's actual default. Such an action could result in the surety paying for damages not covered by the bond, or for which the principal is not truly liable, exposing the surety to unnecessary financial risk and potentially violating the principle of subrogation by not preserving the surety's rights against the principal. Another incorrect approach, which is to deny the claim solely based on the principal's assertion of financial hardship without independent verification, is also professionally flawed. While the principal's financial situation is a factor, it does not automatically absolve them of their contractual obligations or negate the obligee's legitimate claim. This approach fails to conduct a proper evaluation of the evidence presented by the obligee and may lead to a breach of the surety's duty to the obligee, potentially resulting in litigation and reputational damage. A third incorrect approach, which is to delay the investigation indefinitely while awaiting the outcome of separate legal proceedings between the principal and obligee, is also problematic. While coordination with other legal matters may be necessary, an indefinite delay can prejudice the obligee and may violate the surety's obligation to handle claims in a timely manner. The surety has an independent duty to investigate and resolve the claim under the bond, and prolonged inaction can be construed as bad faith. Professionals should employ a decision-making process that prioritizes a structured and evidence-based approach to claims handling. This involves establishing clear internal procedures for claim investigation, evaluation, and resolution, ensuring that all personnel are trained in these procedures and understand their ethical and regulatory obligations. When faced with a complex claim, the professional should 1. Acknowledge the claim promptly and communicate with all parties. 2. Conduct a thorough and impartial investigation, gathering all necessary documentation and information. 3. Objectively evaluate the claim based on the evidence and the terms of the bond. 4. Explore all available resolution options, considering the interests of all parties and the surety's obligations. 5. Document all actions and decisions meticulously. This systematic approach ensures fairness, compliance, and sound risk management. Question 7. Assessment of the underwriting process for a large public works contract performance bond, where the principal, a relatively new but ambitious contractor, is experiencing rapid growth and has provided unaudited financial statements indicating strong current profitability, but has requested an expedited bond issuance due to a tight project bid deadline. What is the most appropriate course of action for the surety underwriter? Option A. Decline to issue the bond until audited financial statements are provided and a comprehensive review of the principal's project management capabilities and backlog is completed, even if this means the contractor misses the bid deadline. Option B. Issue the bond immediately to meet the contractor's deadline, relying on the principal's assurances of future success and the strong market demand for their services. Option C. Issue the bond after obtaining a robust collateral agreement and a strong corporate indemnity from the principal's principals, while clearly documenting the reliance on these security measures in lieu of a full audited financial review. Option D. Issue the bond with a significantly reduced penalty amount and a shorter term, contingent on the principal securing a co-surety with a stronger financial profile. Correct answer is C. Issue the bond after obtaining a robust collateral agreement and a strong corporate indemnity from the principal's principals, while clearly documenting the reliance on these security measures in lieu of a full audited financial review. Explanation: this scenario presents a professional challenge because it requires a surety underwriter to balance the immediate need for a bond with the long-term financial health and risk exposure of the surety company. The underwriter must navigate the complexities of contract surety, specifically the obligations and potential liabilities arising from performance and payment bonds, while adhering to the principles of sound underwriting and regulatory compliance. The challenge lies in accurately assessing the principal's capacity and the project's risk without succumbing to pressure for expediency, which could lead to significant financial losses for the surety. The correct approach involves a thorough and documented review of the principal's financial statements, relevant project documentation, and the principal's experience and capacity to perform the contract. This includes verifying the accuracy of information provided, assessing the principal's creditworthiness, and understanding the specific terms and conditions of the underlying contract. Regulatory frameworks governing surety operations, such as those enforced by state insurance departments in the U.S., mandate prudent underwriting practices to ensure the solvency of surety companies and protect obligees. Adhering to these principles, which emphasize risk assessment and mitigation, is essential for fulfilling the surety's obligations responsibly and maintaining market confidence. An incorrect approach would be to issue the bond based solely on the principal's assurance of future profitability or a strong relationship with the contractor, without conducting adequate due diligence. This bypasses the fundamental underwriting principle of assessing current capacity and risk, potentially violating regulatory requirements for sound financial management and risk assessment. Another incorrect approach is to rely on incomplete or unverified financial information. Regulatory guidelines typically require underwriters to obtain and scrutinize audited financial statements to accurately gauge a principal's financial strength. Failing to do so exposes the surety to unforeseen liabilities and can be seen as a dereliction of duty, potentially leading to regulatory sanctions. Lastly, overlooking the specific terms and conditions of the underlying contract, such as onerous indemnity clauses or unusual project specifications, represents a failure to adequately assess the surety's exposure. This can lead to unexpected claims and losses, undermining the surety's financial stability and violating the principle of prudent risk management. Professional decision-making in such situations requires a systematic process. First, clearly define the scope of the surety's potential liability under the bond and the underlying contract. Second, gather and independently verify all relevant information regarding the principal's financial health, operational capacity, and the project's risk factors. Third, apply established underwriting guidelines and risk assessment methodologies, ensuring compliance with all applicable regulations. Finally, document the entire underwriting process, including the rationale for the decision, to provide a clear audit trail and demonstrate adherence to professional standards and regulatory requirements. Question 8. Upon reviewing the financial statements of a principal who is experiencing significant cash flow difficulties and has several large, upcoming bonded projects, what is the most prudent course of action for a surety company to take to manage its potential exposure? Option A. Continue to issue new bonds for the principal as requested, assuming the principal's past performance indicates a low likelihood of default. Option B. Rely solely on the principal's verbal assurances that they are actively working to resolve their financial issues and will not default on any obligations. Option C. Immediately demand all available collateral from the principal to cover the maximum potential exposure on all outstanding bonds. Option D. Conduct a comprehensive review of the principal's financial health, the status of all bonded obligations, and the adequacy of existing collateral, and determine if additional collateral is required to mitigate potential claims. The correct answer is D. Conduct a comprehensive review of the principal's financial health, the status of all bonded obligations, and the adequacy of existing collateral, and determine if additional collateral is required to mitigate potential claims. Explanation: this scenario presents a professional challenge due to the inherent conflict between a surety's obligation to its principal and its duty to protect its own financial interests, and those of its indemnitors. The principal's financial distress directly impacts the surety's exposure, necessitating a careful assessment of potential claims and the adequacy of collateral. The challenge lies in balancing the need to support the principal's ongoing operations to mitigate losses against the risk of increasing the surety's own liability. The correct approach involves a thorough and documented review of the principal's financial condition, the terms of the bonded obligations, and the collateral security. This includes assessing the likelihood and potential quantum of claims, evaluating the principal's recovery plan, and determining if additional collateral is warranted to secure the surety's exposure. This approach aligns with the surety's fundamental principles of risk management, underwriting discipline, and the contractual obligations to its indemnitors. Regulatory frameworks, such as those governing insurance and financial services, mandate prudent risk assessment and the maintenance of adequate reserves and security to ensure solvency and protect policyholders and stakeholders. Ethical considerations also demand transparency and fairness in dealings with all parties involved. An incorrect approach would be to ignore the principal's financial distress and continue to issue new bonds without a comprehensive review. This fails to adhere to the principle of prudent underwriting, which requires continuous monitoring of risk. Ethically, it exposes the surety to undue financial risk and potentially breaches its duty to its indemnitors by not safeguarding their collateral. Another incorrect approach would be to immediately demand all available collateral without a proper assessment of the principal's ability to cure its default or the potential impact on the bonded projects. This could be seen as an overreaction, potentially jeopardizing the principal's ability to complete its obligations, leading to greater losses for all parties, and potentially violating contractual provisions regarding collateral calls. It also demonstrates a lack of professional judgment in seeking a balanced resolution. A further incorrect approach would be to rely solely on the principal's assurances without independent verification of its financial status or the viability of its recovery plan. This neglects the surety's responsibility for due diligence and exposes the surety to significant risk if the principal's representations are inaccurate. Professional decision-making in such situations requires a systematic process. First, understanding the nature and extent of the principal's financial distress. Second, quantifying the surety's potential exposure. Third, evaluating the effectiveness of existing collateral and the need for additional security. And fourth, developing a strategy that balances risk mitigation with the potential for principal recovery, all while adhering to regulatory requirements and ethical standards. Question 9. The assessment process reveals that a principal seeking a significant contract bond has offered real estate valued by the principal at $500,000 and marketable securities valued at $300,000 as collateral. The principal wishes to retain possession and control of both asset types. The surety's underwriting guidelines require collateral to be fully perfected and valued at market value. Which of the following approaches best aligns with the surety's underwriting guidelines and regulatory principles for collateral requirements? Option A. Obtain a letter of intent from the principal to pledge the real estate and securities at a later date once the bond is issued. Option B. Accept a second mortgage on the real estate, assuming the principal's equity is sufficient, and allow the principal to retain control of the securities. Option C. Accept the principal's stated value for the real estate and the securities, as the principal is offering them in good faith. Option D. Obtain a professional appraisal of the real estate and ensure the surety's lien is properly recorded. For the securities, require them to be held in a segregated account in the surety's name or under a custodial agreement with a third party. The correct answer is D. Obtain a professional appraisal of the real estate and ensure the surety's lien is properly recorded. For the securities, require them to be held in a segregated account in the surety's name or under a custodial agreement with a third party. Explanation. The assessment process reveals a common challenge in surety bonding, accurately valuing and perfecting collateral to mitigate risk for the surety. This scenario is professionally challenging because the value of collateral can fluctuate, and the legal mechanisms for securing a surety's interest perfection are complex and jurisdiction-specific. Misjudging either aspect can lead to significant financial loss for the surety if the principal defaults. Careful judgment is required to ensure the collateral provides adequate security without imposing undue burdens on the principal. The correct approach involves obtaining a professional appraisal of the real estate and then ensuring the surety's lien is properly recorded in accordance with the relevant jurisdiction's real property statutes and UCC filing requirements for personal property. This ensures the surety has a legally enforceable claim that takes priority over other creditors, thereby perfecting its security interest. This aligns with the principle of prudent risk management and adherence to legal requirements for collateralization, ensuring the surety's financial protection is robust and legally sound. An incorrect approach would be to accept the principal's stated value of the real estate without independent verification. This fails to meet the regulatory expectation of due diligence in assessing collateral adequacy and exposes the surety to risk if the actual market value is lower. Ethically, it is a failure to act in the best interest of the surety by not performing a thorough risk assessment. Another incorrect approach would be to accept a second mortgage on the real estate without investigating the terms and priority of the existing first mortgage. This neglects the critical step of understanding the surety's position in the collateral's priority, which is essential for effective perfection. Failure to do so means the surety's claim may be subordinate to the first mortgagee, rendering the collateral less secure. This is a regulatory failure in understanding and applying the principles of lien perfection. Finally, accepting readily marketable securities, but failing to ensure they are properly transferred into the surety's control or held by a neutral third party under a custodial agreement, is also an incorrect approach. This fails to perfect the surety's security interest, leaving the collateral vulnerable to claims by other parties or the principal's dissipation of the assets. This is a direct violation of the principles of collateral perfection and prudent risk management. Professionals should approach collateral assessment by first understanding the specific requirements of the surety bond and the principal's financial situation. They must then identify potential collateral types, research their typical valuation methods and legal perfection requirements within the governing jurisdiction, and obtain independent verification of value and legal status before accepting them. A systematic process of due diligence, legal review, and risk assessment is paramount. Question 10. Performance analysis shows a principal has a strong financial history, but has recently experienced significant turnover in their project management team and has a history of underestimating project timelines on similar, albeit smaller, undertakings. The surety underwriter is considering approving a bond for a large, complex project. Which of the following approaches best reflects sound surety underwriting principles in assessing the principal's capacity for this project? Option A. Conduct a detailed review of the principal's proposed project management plan, the experience of the proposed project team, and verify the availability of key resources, while also considering the financial implications of potential delays. Option B. Rely primarily on the principal's assurances that they will hire experienced project managers and that the financial strength of the company will cover any unforeseen cost overruns. Option C. Prove the bond based on the principal's strong financial statements, assuming that their financial capacity will enable them to overcome any operational challenges. Option D. Delegate the entire assessment of the principal's project management capabilities to an external consultant and accept their recommendation without independent verification. The correct answer is A. Conduct a detailed review of the principal's proposed project management plan, the experience of the proposed project team, and verify the availability of key resources, while also considering the financial implications of potential delays. Explanation. This scenario presents a professional challenge because a surety underwriter must assess the capacity of a principal to undertake a complex project, which directly impacts the surety's risk exposure. The principal's project management skills and resource availability are critical indicators of their ability to perform the bonded obligation. A failure to accurately assess these factors can lead to default, significant financial loss for the surety, and potential reputational damage. The challenge lies in gathering sufficient, reliable information and interpreting it objectively, balancing the desire to secure business with the imperative of prudent risk management. The correct approach involves a thorough, documented review of the principal's historical project performance, their proposed project plan, and their available resources. This includes evaluating the experience of the project management team, the adequacy of their staffing plan, the availability of necessary equipment and materials, and their financial capacity to manage cash flow during the project. Regulatory frameworks, such as those governing financial institutions and insurance, emphasize the importance of due diligence and risk assessment in underwriting. Ethical principles require the underwriter to act in the best interest of the surety by avoiding undue risk. This approach aligns with the principles of sound surety underwriting, which mandate a comprehensive evaluation of the principal's ability to perform. An incorrect approach that focuses solely on the principal's financial statements without a detailed examination of their project management capabilities is professionally unacceptable. Financial statements alone do not reveal the operational capacity to execute a project. This failure to assess operational capacity is a direct contravention of prudent underwriting principles and could be seen as a breach of the underwriter's duty to the surety. Another incorrect approach that relies heavily on the principal's optimistic projections and assurances without independent verification of their project management team's experience or resource availability is also professionally unsound. This approach prioritizes securing the bond over a rigorous risk assessment, potentially exposing the surety to significant losses. It demonstrates a lack of due diligence and a disregard for the fundamental principles of risk management inherent in surety bonding. A third incorrect approach that delegates the entire project management capacity assessment to a third-party consultant without the underwriter performing their own critical review and due diligence is also problematic. While consultants can provide valuable input, the ultimate responsibility for underwriting decisions rests with the surety's appointed personnel. Abdicating this responsibility without independent verification is a failure of professional judgment and oversight. The professional decision-making process for similar situations should involve a structured, risk-based approach. This includes 1. Clearly defining the scope of the assessment based on the project's complexity and value. 2. Gathering comprehensive information from the principal, including project plans, resumes of key personnel, equipment schedules, and financial data. 3. Conducting independent verification where possible, such as checking references for project managers or assessing the availability of critical equipment. 4. Critically evaluating the gathered information, identifying potential risks and mitigation strategies. And 5. Documenting the entire assessment process and the rationale for the underwriting decision. This systematic approach ensures that decisions are informed, defensible, and aligned with regulatory requirements and ethical obligations. Question 11. Implementation of a subdivision bond for a new residential development requires the surety to understand the precise nature of the developer's obligations for public improvements. Which of the following approaches best ensures the surety's liability is appropriately defined and managed according to regulatory principles? Option A. Reviewing the subdivision agreement, plat map, and relevant municipal ordinances to ascertain the specific public improvements the developer is contractually and legally obligated to complete to prescribed standards. Option B. Underwriting the bond based on the estimated market value of the completed development, assuming this will cover any potential improvement costs. Option C. Relying solely on the standard subdivision bond form, assuming it encompasses all potential improvements required for any subdivision project. Option D. Accepting the developer's verbal assurance that all necessary public improvements will be completed without requiring detailed documentation. The correct answer is A. Reviewing the subdivision agreement, plat map, and relevant municipal ordinances to ascertain the specific public improvements the developer is contractually and legally obligated to complete to prescribed standards. Explanation. This scenario presents a professional challenge because subdivision bonds are critical financial instruments designed to protect public interest by ensuring developers fulfill their obligations for public improvements. Misunderstanding their purpose or coverage can lead to significant financial exposure for the surety, the municipality, and ultimately, the public. The core of the challenge lies in accurately assessing the scope of the developer's commitment and the surety's liability, which requires a thorough understanding of local ordinances and the specific terms of the bond. The correct approach involves a meticulous review of the subdivision agreement, the plat map, and all relevant municipal ordinances governing subdivision development and public improvements. This ensures the surety fully comprehends the developer's responsibilities, such as the construction of roads, utilities, and drainage systems, and the specific standards to which these must be built. This detailed understanding is crucial for accurate risk assessment and underwriting. Aligning with the principle of ensuring the surety's commitment is commensurate with the developer's obligations as defined by law and contract. This approach upholds the surety's duty to provide financial guarantees that are both adequate and appropriate for the underlying project, thereby protecting public funds and infrastructure. An incorrect approach that focuses solely on the bond form without examining the underlying development agreement and municipal requirements fails to grasp the full scope of the surety's potential liability. This oversight can lead to underpricing the bond or accepting inadequate collateral, as the true extent of the developer's obligations, and thus the surety's risk, is not fully understood. This is a regulatory failure, as it deviates from the principle of prudent underwriting based on a comprehensive understanding of the risk. Another incorrect approach that assumes the bond automatically covers all potential costs associated with the subdivision, regardless of specific contractual or ordinance-based obligations, is also professionally unacceptable. This broad assumption ignores the principle of specificity in surety agreements. The surety's liability is typically limited to the obligations explicitly defined in the bond and its supporting documents, not a general guarantee of project success or completion of all conceivable improvements. This can lead to disputes and claims that extend beyond the surety's intended exposure, creating financial instability and potentially violating principles of fair dealing with the obligee. Professionals should adopt a decision-making process that prioritizes due diligence and a thorough understanding of the specific regulatory and contractual landscape governing subdivision bonds. This involves a systematic review of all relevant documentation, consultation with legal counsel or subject matter experts when necessary, and a clear articulation of the surety's obligations and limitations. This structured approach ensures that the surety's commitment is well-defined, adequately priced, and aligned with the developer's legally binding responsibilities, thereby mitigating risk and upholding professional standards. Question 12. Which approach would be most appropriate for a surety underwriter when evaluating a request for a tax bond to guarantee a business's compliance with state sales tax obligations? Option A. Recommend a broad coverage that indemnifies the principal against any financial losses incurred during the tax period, irrespective of direct tax noncompliance. Option B. Evaluate the principal's business plan and market position to gauge their long-term viability, assuming a viable business is less likely to default on tax payments. Option C. Prioritize assessing the principal's established tax compliance procedures, historical reporting accuracy, and remittance timeliness, ensuring coverage aligns precisely with the state's sales tax laws and the bond's purpose of guaranteeing payment of legally owed taxes. Option D. Focus on the principal's overall financial health and creditworthiness to ensure they can absorb potential tax liabilities. Correct answer is D. Focus on the principal's overall financial health and creditworthiness to ensure they can absorb potential tax liabilities. Explanation. This scenario presents a professional challenge because it requires a nuanced understanding of tax bond principles and their application within the specific regulatory framework governing surety bonding in the United States. The core of the challenge lies in correctly identifying the primary purpose of a tax bond and ensuring that the proposed coverage aligns with compliance requirements, rather than merely addressing a perceived financial risk. A surety professional must distinguish between the surety's role in guaranteeing compliance with tax obligations and acting as a general insurer against all potential financial losses. The correct approach is to recognize that a tax bond's fundamental purpose is to guarantee the principal's compliance with tax laws and regulations, ensuring that all legally owed taxes are paid. This approach aligns with the regulatory intent of such bonds, which is to protect the taxing authority from non-payment or underpayment of taxes by the principal. The coverage should be tailored to this specific risk, focusing on the principal's adherence to tax reporting and remittance obligations. This is ethically sound as it upholds the integrity of the tax system and the surety's commitment to its contractual obligations. An incorrect approach would be to view the tax bond primarily as a mechanism to cover any and all financial shortfalls of the principal, regardless of whether they stem directly from non-compliance with tax laws. This misinterprets the surety's role, which is not to act as a lender or a general guarantor of business success. Such an approach could lead to the surety assuming risks beyond the scope of the tax bond, potentially exposing it to losses not contemplated by the underwriting process, and violating the principle of limiting surety obligations to the specific guarantees provided. Another incorrect approach would be to focus solely on the principal's financial stability without adequately assessing their tax, compliance history, and procedures. While financial strength is a factor in underwriting, it is secondary to the principal's demonstrated ability and willingness to comply with tax laws. A financially strong principal can still be non-compliant, leading to a claim on the bond. This approach fails to address the core risk. The tax bond is designed to mitigate non-compliance with tax obligations. A further incorrect approach would be to recommend coverage that extends beyond the statutory or regulatory requirements for the specific tax obligation being bonded. Tax bonds are typically issued to satisfy specific legal mandates. Expanding coverage beyond these mandates without a clear understanding of the underlying tax law and the taxing authority's requirements could result in an improperly underwritten bond and potential disputes over coverage. Professional decision-making in such situations requires a systematic process. First, thoroughly understand the specific tax laws and regulations applicable to the principal and the bond. Second, assess the principal's historical compliance with these laws. Third, determine the precise nature of the guarantee the surety is providing. And finally, ensure that the bond's terms and coverage accurately reflect and are limited to this specific guarantee, protecting both the taxing authority and the surety. Question 13. The analysis reveals that a surety underwriter is reviewing a supply bond application for a large infrastructure project. The contractor has a solid reputation, but has recently experienced some cash flow challenges. The supply bond has a penalty clause set at 10% of the total contract value for the materials being supplied. The underwriter needs to determine the most appropriate risk assessment approach to ensure adequate protection for the obligee and manage the surety's exposure. Option A. Prioritize the speed of bond issuance to meet the project's tight deadlines, assuming the contractor's good reputation will mitigate most default risks. Option B. Accept the 10% penalty as sufficient coverage, as it is a standard percentage for supply bonds, and proceed with issuing the bond without further investigation into the contractor's current financial situation. Option C. Advise the obligee that supply bonds are primarily for labor and materials, and the penalty clause is a fixed amount that cannot be adjusted, regardless of the potential loss. Option D. Focus on the contractor's historical performance and the potential cost to the obligee of sourcing alternative suppliers if the contractor defaults, assessing if the 10% penalty is likely to cover these costs and any consequential damages. Correct answer is D. Focus on the contractor's historical performance and the potential cost to the obligee of sourcing alternative suppliers if the contractor defaults, assessing if the 10% penalty is likely to cover these costs and any consequential damages. Explanation. This scenario is professionally challenging because it requires a nuanced understanding of supply bond principles within the specific regulatory framework of surety bonding, without resorting to simple calculations. The underwriter must assess the potential for contractor default and the subsequent impact on the obligee, considering the specific coverage and penalty clauses of the supply bond. This necessitates a deep dive into the contractor's financial stability, their capacity to perform, and the potential financial exposure if they fail to deliver the specified materials or services. The correct approach involves a thorough risk assessment focused on the contractor's ability to fulfill the contractual obligations as defined by the supply bond. This means evaluating the contractor's financial health, operational capacity, and track record. Critically, it also involves understanding the specific terms of the supply bond, particularly the penalty clause. The penalty clause dictates the maximum liability of the surety. A prudent underwriter will assess whether this penalty is sufficient to cover the obligee's potential losses arising from the contractor's default, considering the cost of procuring substitute materials or services and any consequential damages. This aligns with the principle of ensuring the surety's exposure is commensurate with the risk undertaken, as implicitly guided by principles of sound underwriting and risk management within the surety industry. An incorrect approach would be to solely focus on the face value of the bond, without considering the likelihood of default or the actual potential loss to the obligee. This overlooks the core purpose of a supply bond, which is to protect the obligee against financial harm resulting from non-performance. Another incorrect approach would be to ignore the specific terms of the penalty clause, assuming it automatically covers all potential losses. This demonstrates a failure to appreciate the contractual limitations of the surety's obligation and could lead to underpricing the risk or failing to adequately collateralize the bond. A third incorrect approach would be to prioritize speed of issuance over thorough due diligence, especially when dealing with significant contract values or contractors with a less established history. This bypasses essential risk assessment steps and exposes the surety to undue risk. Professionals should employ a decision-making framework that prioritizes a comprehensive understanding of the underlying contract, the contractor's capabilities, and the specific terms and conditions of the surety bond. This involves a qualitative assessment of risk factors, a thorough review of financial statements and performance history, and a clear understanding of the surety's potential liability as defined by the bond's penalty. The process should involve questioning assumptions, seeking clarification on ambiguous terms, and ensuring that the bond structure adequately mitigates the identified risks for both the obligee and the surety. Question 14. The evaluation methodology shows an underwriter examining a principal's financial statements to determine its capacity to absorb potential losses. Which of the following best reflects a comprehensive approach to assessing the principal's capital adequacy for surety bonding purposes, considering the regulatory emphasis on financial resilience? Option A. A cursory review of the principal's most recent balance sheet to confirm it has a positive net worth, without further investigation into the nature of its assets or liabilities. Option B. A detailed analysis of the principal's working capital trends, the composition and quality of its net worth, and its cash flow liquidity, benchmarked against industry norms and the specific risks of the proposed bonds. Option C. An exclusive focus on the principal's current ratio, assuming that a ratio above 1.5 indicates sufficient liquidity for any surety bonding requirement. Option D. A simple calculation of the principal's debt-to-equity ratio, prioritizing a low ratio as the sole indicator of strong capital adequacy. The correct answer is B. A detailed analysis of the principal's working capital trends, the composition and quality of its net worth, and its cash flow liquidity, benchmarked against industry norms and the specific risks of the proposed bonds. Explanation. The evaluation methodology shows a surety underwriter assessing the capital adequacy of a principal. This scenario is professionally challenging because it requires a nuanced understanding of financial health beyond simple ratios, particularly in the context of surety bonding, where the underwriter assumes significant risk. The principal's ability to meet its obligations, especially during periods of economic downturn or project-specific challenges, is directly tied to its capital structure. A thorough assessment is crucial to avoid overbonding a principal that lacks the financial resilience to absorb potential losses, which could lead to default and significant financial repercussions for the surety. The correct approach involves a comprehensive review of the principal's working capital, net worth, and liquidity, considering both quantitative measures and qualitative factors. This includes analyzing trends in these metrics over time, understanding the nature of the principal's assets and liabilities, and assessing the quality of its earnings and cash flow. Regulatory frameworks for surety bonding, such as those overseen by bodies like the NAIC, National Association of Insurance Commissioners, in the U.S., emphasize the importance of a surety's financial strength to protect policyholders and maintain market stability. A robust capital adequacy assessment ensures the surety can meet its obligations, aligning with the ethical duty to act prudently and responsibly. An incorrect approach would be to solely rely on a single financial metric, such as a simple current ratio, without considering the broader context. This fails to capture the underlying risks and may provide a misleading picture of the principal's true financial stability. For instance, a high current ratio might be artificially inflated by slow-moving or obsolete inventory, or by short-term debt that is difficult to service. Another incorrect approach is to ignore the principal's industry-specific financial norms. Different industries have varying capital requirements and risk profiles, and failing to account for these differences can lead to an inaccurate assessment. For example, a construction company might have different working capital needs than a technology firm. Ethically, this demonstrates a lack of due diligence and a failure to apply professional judgment. A third incorrect approach is to overlook the quality and composition of the principal's assets and liabilities, focusing only on the total figures without scrutinizing whether assets are readily convertible to cash or if liabilities are manageable can lead to an underestimation of risk. This violates the principle of prudent underwriting and can expose the surety to undue risk. Professionals should adopt a holistic risk assessment framework. This involves gathering comprehensive financial statements, understanding the principal's business operations and industry, and performing trend analysis. They must then critically evaluate the principal's capital adequacy by considering the interplay between working capital, net worth, and liquidity, always in light of the specific risks associated with the surety bonds being considered. This process requires judgment, experience, and a commitment to regulatory compliance and ethical underwriting standards. Question 15. Quality control measures reveal that a new client, importing a variety of electronic goods into the UK, has been issued a standard customs bond that appears to cover only the payment of import duties. The client's import activities also involve goods subject to specific excise duties and environmental levies, which are not explicitly mentioned in the bond's coverage. Given the principles of surety bonding and UK import regulations, what is the most appropriate course of action for the surety agent? Option A. Proceed with renewing the existing bond as is, assuming the client will manage any additional tax liabilities separately. Option B. Inform the client that the current bond is inadequate and suggest they consult directly with HMRC to determine the necessary bond requirements. Option C. Advise the client that the existing bond is sufficient as it covers the primary customs duty obligation and any other liabilities are separate. Option D. Immediately recommend the client obtain an updated customs bond that explicitly covers all potential liabilities, including excise duties and environmental levies, in addition to import duties, to ensure full compliance with UK import regulations. The correct answer is C. Advise the client that the existing bond is sufficient as it covers the primary customs duty obligation and any other liabilities are separate. Explanation. This scenario presents a professional challenge because it requires the surety agent to navigate the complexities of customs regulations and the specific requirements of a customs bond to ensure compliance for their client. The agent must understand not only the purpose of the bond, but also the precise coverage it offers and how it interacts with import regulations to prevent potential financial liabilities for both the importer and the surety company. The challenge lies in accurately assessing the client's operational needs against the bond's provisions and the regulatory landscape. The correct approach involves a thorough review of the client's import activities and a clear understanding of the specific customs bond type required. This approach prioritizes ensuring the bond adequately covers the client's obligations under customs law, such as the payment of duties, taxes, and fees, and compliance with import regulations. By confirming the bond's coverage aligns with the client's import volume, product types, and regulatory scrutiny, the agent fulfills their duty to provide appropriate surety solutions and mitigates risk for all parties involved. This aligns with the principles of responsible surety underwriting and adherence to customs regulations designed to protect government revenue and ensure lawful trade. An incorrect approach would be to assume a standard customs bond is sufficient without a detailed assessment of the client's specific import operations. This failure to tailor the bond to the client's needs could leave gaps in coverage, potentially exposing the importer to penalties or the surety to unforeseen claims if the bond does not adequately address all potential liabilities under customs law. Another incorrect approach would be to focus solely on the premium cost without adequately verifying the bond's compliance with all relevant import regulations. This prioritizes commercial gain over regulatory adherence and client protection, which is a significant ethical and professional failing. A third incorrect approach would be to provide a bond that covers only a portion of the potential customs liabilities, such as duties, but neglects other potential obligations like excise taxes or fees, thereby creating a false sense of security for the importer and exposing the surety to uncovered risks. Professionals should approach such situations by first identifying the specific regulatory framework governing the transaction, in this case, customs import regulations. They should then analyze the client's business activities to determine the exact nature and extent of their obligations under these regulations. This analysis should inform the selection of the appropriate customs bond type and ensure its coverage is comprehensive and compliant. A structured decision-making process would involve 1. Understanding the client's import profile. 2. Identifying all potential customs liabilities. 3. Researching the specific requirements for customs bonds related to those liabilities. 4. Selecting a bond that offers adequate coverage and meets regulatory standards. And 5. clearly communicating the bond's coverage and limitations to the client. Question 16. Strategic planning requires a clear understanding of the specific protections offered by various surety instruments. When an obligee requests a bond to facilitate the issuance of a replacement for a lost negotiable instrument, which of the following best describes the primary purpose and coverage of such a bond, particularly concerning indemnification? Option A. To act as a collateral deposit, securing the obligee's funds against potential defaults by the issuer of the replacement instrument, irrespective of the original instrument's status. Option B. To serve as a performance guarantee, ensuring that the issuer of the replacement instrument fulfills all contractual obligations related to the original instrument's terms and conditions. Option C. To indemnify the obligee against any loss, cost, or expense incurred if the original lost negotiable instrument is subsequently presented for payment or endorsement, thereby protecting the obligee from double payment or related claims. Option D. To provide the obligee with a general guarantee of the issuer's financial stability and to cover any and all potential liabilities the obligee might face in their business operations. The correct answer is D. To provide the obligee with a general guarantee of the issuer's financial stability and to cover any and all potential liabilities the obligee might face in their business operations. Explanation. This scenario is professionally challenging because it requires a nuanced understanding of lost instrument bonds, specifically their purpose, coverage, and the implications of indemnification within the strict confines of the surety bonding principles certificate regulatory framework. The core challenge lies in accurately identifying the primary function of a lost instrument bond and distinguishing it from other types of surety instruments or general indemnity agreements. A thorough grasp of the underlying legal principles and the specific protections afforded by this type of bond is essential to avoid misrepresenting its scope or the surety's obligations. The correct approach focuses on the fundamental purpose of a lost instrument bond: to protect the obligee from potential liability arising from the representation of a lost or stolen negotiable instrument. This bond essentially indemnifies the obligee against any loss or expense incurred if the original instrument reappears and is presented for payment or endorsement after a replacement has been issued. Regulatory guidelines for surety bonding principles emphasize that such bonds are designed to facilitate the replacement of lost instruments by providing a financial guarantee against future claims. The surety's undertaking is specific to the risk of the lost instrument being presented, and the indemnification clause is directly tied to this risk. An incorrect approach that overemphasizes the surety's general financial strength or broad indemnification capabilities without linking it to the specific risk of the lost instrument fails to adhere to the principles of surety bonding. Such an approach misrepresents the bond's limited scope and could lead to the obligee expecting coverage for risks not contemplated by the lost instrument bond. This violates the regulatory principle of accurate representation of surety products and their associated risks. Another incorrect approach might focus solely on the administrative aspects of replacing the instrument, neglecting the crucial element of indemnification against potential future claims. This overlooks the primary reason for requiring the bond in the first place: to mitigate the financial risk to the obligee. Ethically and regulatorily, a surety product must address the specific risk it is designed to cover. The professional decision-making process for similar situations involves a systematic evaluation of the client's request against the established principles and regulatory requirements of surety bonding. Professionals must first identify the specific type of surety product being considered, understand its defined purpose and coverage limitations, and then assess how the proposed indemnification aligns with those parameters. This requires consulting relevant regulatory guidance and surety product manuals to ensure accurate advice and appropriate bond placement, thereby upholding professional integrity and regulatory compliance. Question 17. Quality control measures reveal a notification from an insured business regarding a suspected employee theft of funds. The initial report from the insured is vague, providing only a general description of the employee and an estimated financial impact, but lacks specific documentation or a detailed timeline of events. The surety underwriter is tasked with determining the appropriate next steps. Option A. Initiate a comprehensive investigation to gather all relevant facts, review the fidelity bond policy terms, and assess the validity and extent of the alleged loss. Option B. Immediately issue payment to the insured based on the estimated financial impact to maintain a positive client relationship. Option C. Contact the insured to renegotiate the terms of the fidelity bond to potentially limit the surety's exposure before proceeding with any investigation. Option D. Deny the claim outright due to the lack of detailed documentation in the initial notification. The correct answer is A. Initiate a comprehensive investigation to gather all relevant facts, review the fidelity bond policy terms, and assess the validity and extent of the alleged loss. Explanation. Scenario analysis. This scenario is professionally challenging because it requires the surety underwriter to balance the immediate need to address a potential loss with the contractual obligations and the principles of fair dealing inherent in surety bonding. The underwriter must act decisively to protect the surety's interests, while also ensuring that the insured party's rights are not unduly infringed upon, especially when the evidence of loss is still developing. The challenge lies in gathering sufficient information to make an informed decision without prematurely denying a claim or incurring unnecessary expenses. Correct approach analysis. The correct approach involves initiating a thorough investigation into the fidelity claim. This aligns with the underwriter's duty to investigate all claims promptly and fairly, as stipulated by regulatory frameworks governing insurance and surety. A comprehensive investigation allows the underwriter to gather all necessary facts, assess the validity and extent of the loss, and determine the insured's compliance with policy conditions. This methodical process ensures that the surety's decision is based on evidence and adheres to the terms of the fidelity bond, thereby upholding the principles of good faith and fair dealing. Incorrect approaches analysis. Initiating immediate payment without a thorough investigation is an incorrect approach because it bypasses the contractual requirement for the surety to ascertain the validity of the claim. This could lead to paying for losses not covered by the bond or losses that are not substantiated, exposing the surety to financial risk and potentially violating principles of prudent underwriting and claims handling. Denying the claim outright based on preliminary suspicions without a full investigation is also incorrect. It fails to meet the regulatory and ethical obligation to investigate claims thoroughly and fairly. Such an action could be construed as bad faith, leading to regulatory penalties and reputational damage, as it prematurely dismisses the insured's potential entitlement under the bond. Seeking to renegotiate the bond terms with the insured before investigating the claim is inappropriate. The fidelity bond is a contract with established terms. Attempting to alter these terms in response to a potential claim, especially before understanding the facts, undermines the integrity of the contractual agreement and suggests an attempt to avoid responsibility rather than address the claim appropriately. Professional reasoning. Professionals should approach fidelity bond claims by first acknowledging the notification and then immediately commencing a structured investigation. This involves reviewing the bond policy, understanding the nature of the alleged loss, gathering evidence from the insured, and potentially interviewing relevant parties. The decision-making process should be guided by the bond's terms, applicable regulations, and ethical principles of fair investigation and claims handling. If the investigation confirms a covered loss, the claim should be paid according to the policy terms. If the investigation reveals no covered loss or policy violations, a reasoned denial supported by evidence should be issued. Question 18. Consider a scenario where a contractor, who is a client of a surety agency, is seeking a performance bond for a large construction project. The contractor states, "I just need this bond to guarantee that the project owner gets paid if I can't finish the job." It's basically like an insurance policy for them, right? The surety agent is aware that the contractor is seeking to understand the bond's function primarily as a payment guarantee rather than a performance assurance. What is the most appropriate course of action for the surety agent in this situation? Option A. Issue the bond as requested, assuming the contractor understands the implications, and focus on securing the necessary underwriting information without further clarification on the bond's purpose. Option B. Agree with the contractor's description, stating that the bond functions as an insurance policy for the project owner, ensuring they receive payment regardless of the contractor's ability to complete the work. Option C. Explain to the contractor that while the bond does provide financial recourse to the project owner if the contractor defaults, it is fundamentally a performance bond that guarantees the contractor will complete the project according to the contract terms, and that the surety will seek reimbursement from the contractor if a claim is paid. Option D. suggests that the contractor explore obtaining a payment bond and a separate performance bond, without clarifying the distinct roles of each in relation to the current request. The correct answer is C. Explain to the contractor that while the bond does provide financial recourse to the project owner if the contractor defaults, it is fundamentally a performance bond that guarantees the contractor will complete the project according to the contract terms, and that the surety will seek reimbursement from the contractor if a claim is paid. Explanation: this scenario presents a professional challenge because it requires balancing the immediate financial interests of a client with the fundamental principles of surety bonding and regulatory compliance. The surety's obligation is to protect the obligee from financial loss due to the principal's default. Misrepresenting the nature or purpose of a surety bond can lead to significant financial and reputational damage for all parties involved, including the surety, the principal, and potentially the obligee. Careful judgment is required to ensure the bond serves its intended purpose and adheres to regulatory expectations. The correct approach involves clearly and accurately defining the surety bond's purpose and nature to the client. This means explaining that a surety bond is not an insurance policy, but a three-party agreement where the surety guarantees the principal's performance or obligation to the obligee. The surety's role is to ensure the principal fulfills their contractual or legal duties. If the principal defaults, the surety will typically compensate the obligee for losses incurred and then seek reimbursement from the principal. This approach aligns with the core principles of surety bonding, which are designed to provide financial assurance and mitigate risk for the obligee, not to provide a general safety net for the principal. Adhering to this transparent and accurate communication is ethically sound and consistent with regulatory frameworks that expect clear disclosure of financial instruments. An incorrect approach would be to agree with the client's framing that the bond is simply a guarantee of payment without further qualification. This misrepresents the surety's role and the bond's purpose, fails to acknowledge the principal's primary responsibility and the surety's right of indemnity. Ethically, this is misleading. From a regulatory standpoint, it could be seen as a misrepresentation of the product, potentially violating regulations that require accurate descriptions of financial products and services. Another incorrect approach would be to proceed with issuing the bond based solely on the client's request, without clarifying the nuances of its purpose. This demonstrates a lack of due diligence and a failure to educate the client on the implications of the surety agreement. It prioritizes client satisfaction over accurate representation and adherence to the fundamental principles of surety underwriting and the regulatory environment governing such instruments. This can lead to misunderstandings and disputes down the line, potentially exposing the surety to unforeseen risks and regulatory scrutiny. The professional decision-making process for similar situations should involve a commitment to transparency and education. Professionals must first understand the client's needs and objectives. Then, they must accurately explain the nature and purpose of the surety product being considered, highlighting the responsibilities of each party and the conditions under which the surety would be called upon. This involves clearly differentiating surety bonds from other financial products like insurance. If a client's understanding or request is misaligned with the product's true nature, the professional has an ethical and regulatory obligation to correct the misunderstanding and ensure the client enters into the agreement with full knowledge. Question 19. Governance review demonstrates that a surety underwriter is investigating a potential claim on a performance bond for a complex commercial construction project. The principal, a general contractor, is experiencing significant project delays and cost overruns, and the obligee, a private developer, has formally notified the surety of the principal's alleged default. The principal asserts that unforeseen site conditions and subcontractor defaults are the primary causes and has provided some preliminary documentation. The obligee is demanding immediate action from the surety to complete the project. Which of the following approaches best reflects the required investigation and evaluation process for assessing liability in this scenario, adhering strictly to surety bonding principles? Option A. Focus solely on the obligee's demands and the contractual penalties outlined in the performance bond, initiating steps to secure a replacement contractor without a comprehensive evaluation of the principal's performance or the validity of the alleged default. Option B. Accept the principal's explanation for the delays and cost overruns at face value and request additional financial information from the principal to assess their ability to self-cure the issues, thereby avoiding immediate involvement of the obligee in the surety's internal assessment. Option C. Issue a reservation of rights letter to the obligee based on the principal's initial report, indicating that the surety will investigate further but is not yet admitting liability, and await further communication from the obligee before undertaking any independent investigation. Option D. Immediately engage a third-party construction consultant to conduct a thorough site inspection. Review all project documentation including contracts, change orders, and correspondence, and interview key stakeholders from both the principal and obligee to form an independent assessment of the causes of delay and cost overruns, and the principal's remaining obligations and capacity to perform. The correct answer is D. Immediately engage a third-party construction consultant to conduct a thorough site inspection. Review all project documentation including contracts, change orders, and correspondence, and interview key stakeholders from both the principal and obligee to form an independent assessment of the causes of delay and cost overruns, and the principal's remaining obligations and capacity to perform. Explanation. This scenario presents a professional challenge because the surety underwriter must balance the need to gather sufficient information to accurately assess the principal's liability and the obligee's potential claim with the ethical and regulatory obligations to conduct a fair and thorough investigation. The pressure to make a swift decision, especially in a construction context where delays can be costly, can lead to shortcuts that compromise the integrity of the evaluation process. The underwriter must navigate potential conflicts of interest, ensure confidentiality, and adhere to the principles of utmost good faith inherent in surety relationships. The correct approach involves a systematic and comprehensive information gathering process that prioritizes objective evidence and expert analysis. This includes reviewing all relevant contract documents, financial statements, project progress reports, and communication logs. Crucially, it necessitates engaging with all parties involved, the principal, obligee, and any relevant third parties like subcontractors or suppliers to obtain their perspectives and supporting documentation. The underwriter must then critically evaluate this information to determine the principal's likely performance under the bond and the potential exposure to the surety. This aligns with regulatory expectations for prudent underwriting and the ethical duty to act with due diligence and competence, ensuring that decisions are based on a well-informed assessment of risk and liability, thereby protecting the surety's interests and upholding the integrity of the bonding market. An incorrect approach that relies solely on the principal's assurances without independent verification fails to meet the standard of due diligence. This approach neglects the inherent potential for bias in the principal's self-reporting and ignores the regulatory requirement for an objective assessment of risk. It also breaches the principle of utmost good faith by not adequately investigating potential issues that could lead to a claim. Another incorrect approach that involves prematurely denying the claim based on incomplete information is equally problematic. This demonstrates a failure to conduct a thorough investigation, potentially leading to an unfounded denial and a breach of contractual obligations under the bond. It also exposes the surety to reputational damage and potential legal challenges. A third incorrect approach that focuses exclusively on the obligee's demands without independently assessing the principal's capacity or contractual obligations overlooks the surety's tripartite relationship. The surety's liability is contingent on the principal's default and the validity of the obligee's claim, requiring a balanced evaluation of all factors, not just the obligee's assertions. This approach can lead to unnecessary payouts and a failure to mitigate losses effectively. Professionals should employ a structured decision-making process that begins with clearly defining the scope of the investigation based on the nature of the potential claim and the bond type. This involves identifying key information requirements and potential sources. The next step is to systematically gather and document all relevant data, ensuring its accuracy and completeness. This data should then be analyzed critically, considering all perspectives and potential outcomes. Finally, a well-reasoned decision regarding the principal's liability and the surety's course of action should be made, documented, and communicated in accordance with regulatory and ethical guidelines. Question 20. Operational review demonstrates a prime contractor on a state public works project has submitted a claim to the surety for reimbursement of costs incurred due to a subcontractor's default, including the cost of completing the subcontractor's work and additional overhead expenses. The payment bond for this project is governed by the state's Little Miller Act. Which of the following approaches best aligns with the purpose and coverage of a payment bond under such a regulatory framework? Option A. The surety should investigate whether the subcontractor had any outstanding labor or material obligations, and if so, use the prime contractor's claim as a set-off against those potential claims before considering any reimbursement to the prime contractor. Option B. The surety should approve the claim in full, as the prime contractor is ultimately responsible for project completion, and any costs incurred are a direct consequence of the subcontractor's failure. Option C. The surety should consider a partial payment for the direct costs of completing the subcontractor's work, but deny the claim for additional overhead expenses, as overhead is not typically considered a direct labor or material cost. Option D. The surety should deny the claim as payment bonds are intended to protect unpaid laborers and material suppliers, not to reimburse prime contractors for their own costs or overhead associated with subcontractor default. Correct answer is D. The surety should deny the claim as payment bonds are intended to protect unpaid laborers and material suppliers, not to reimburse prime contractors for their own costs or overhead associated with subcontractor default. Explanation. This scenario presents a professional challenge because it requires a nuanced understanding of payment bond principles within the specific regulatory framework governing surety bonding in the United States. The challenge lies in correctly identifying the scope of coverage and the intended beneficiaries of a payment bond, particularly when faced with a claim that might extend beyond the most common interpretations. Careful judgment is required to ensure compliance with the Miller Act for federal projects or Little Miller Acts for state and local projects, which are the foundational laws for public works payment bonds. The correct approach involves recognizing that a payment bond's primary purpose is to protect unpaid laborers and material suppliers who have provided work or materials to the prime contractor or its subcontractors. This protection is crucial for ensuring that those who contribute to public projects are compensated, thereby preventing liens on public property, which are generally not permitted, and fostering a competitive bidding environment. Regulatory framework, particularly the specific wording of the Miller Act or relevant state statutes, defines who is considered a beneficiary and what constitutes covered labor and materials. A payment bond is designed to be a substitute for the lien rights that private property owners, contractors, and suppliers would typically have. An incorrect approach would be to interpret the payment bond's coverage too narrowly, excluding legitimate claims for labor or materials that fall within the statutory definition. For instance, excluding claims for materials that were ordered but not incorporated into the project, or labor performed by a second-tier subcontractor, would likely contravene the protective intent of the bond and the governing statutes. Another incorrect approach would be to interpret the bond too broadly, extending coverage to entities or expenses not contemplated by the payment bond statutes, such as the prime contractor's own overhead or profit on a subcontract that was terminated for cause. This would misapply the purpose of the bond and potentially lead to disputes and litigation. Professionals should approach such situations by first thoroughly understanding the specific payment bond and the governing statute, e.g., the Miller Act or a state's Little Miller Act. They should then meticulously analyze the claimant's demand against the statutory definitions of labor and materials and the chain of privity established by the bond. Consulting legal counsel specializing in construction law and surety is often a critical step when there is ambiguity or a novel claim. The decision-making process should prioritize adherence to the letter and spirit of the law, ensuring that the bond serves its intended purpose of protecting those who have contributed to the public project.